John has worked for Invesco for 44 years. He was a visiting research fellow at the Bank of Japan, and he's worked extensively, especially in Asian markets, including with Milton Friedman in that context. He's a member of the IEA Shadow Monetary Policy Committee, and he has an honorary PhD from the University of Edinburgh. John.
Good morning, everybody. And first off, I want to thank Tim for inviting me, Juan Castaneda and Gail for all their organisation, and for putting on such an interesting conference. Unfortunately, I can't stay the entire day, but I will be here this morning. Tim's assignment to me was to talk about Milton Friedman's views on fiscal policy. Now, fiscal policy has two broad roles, as I would see it. First, obviously, there is the extent of government activity and spending in the economy. And then secondly, the role of fiscal policy in macroeconomic stabilization. My paper focuses on the second phase, doesn't deal with the first at all. To say that as a lifelong classical liberal and an advocate of personal freedom, Milton Friedman believed in a minimum role of government in the economy, a minimum role that was compatible with maximum personal freedom and maximum operation of the market. So he preferred economies like Hong Kong, where government spending was about 20% of GDP, instead of countries of the developed West, where spending is typically 40 or 50% of GDP. But as I say, that's not my subject. My subject is Friedman's view of the role of fiscal policy in macroeconomic stabilization, and in particular, its interaction with monetary policy. So my paper is divided into 4 sections. The first 4 items or topics are the ones listed here, and then I've got a brief statement I want to make about policy implications. And I'll spend most of the time on section 3.
Sorry, I'm going to scroll down. Just bear with me, sorry.
So first we have to deal with this issue that Friedman had different views on fiscal policy at different stages of his life. And I deal with that fairly quickly, I think, in the first section of my paper. As you all know, he wrote these papers on discussion of the inflationary gap, monetary and fiscal framework for economic stability in the 1940s. They were reprinted in the essays in positive economics, and with considerable amendments, because by then he'd discovered something that he'd left out, and that is the role of monetary policy. You see, his view at that time was basically a conventional Keynesian view. He absorbed the Keynesian view that was developing through the 40s, and particularly during his work at the US Treasury during the war. And he changed those papers accordingly after he went back to Chicago and started to get in contact with the real data. He says in his interview with John Taylor, in the earlier paper, that's the one at the top, the inflationary gap, I was at the point where I would say money is important, but the quantity of money should vary counter-cyclically, increase when there was a recession, and the opposite, decrease when there was an expansion. Rules for taxes and spending that would give budget balance on average, but have deficits and surpluses over the cycle, that could automatically impart the right movement to the quantity of money. But then I got involved, I'm quoting still, in the statistical analysis of the role of money and the relation between money and money income. And I came to the conclusion that this policy was more complicated than necessary, the one he just advocated. You really didn't need to worry too much about what was happening on the fiscal end. You should just concentrate on keeping the money supply rising at a constant rate. The conclusion was, I'm sure, the result of the empirical evidence. Now, he gave that interview when he was age 88, so his memory might have been fading a bit by then. But anyway, he remained very sharp. So his early views then were basically acceptance of the general theory, but they were untested. And the great thing about Friedman is that he was an empirical economist. He checked the data. After he had an opportunity to check the data, he rejected that counter-cyclical view of monetary policy, and therefore abandoned the whole idea that fiscal policy could be stabilizing, and shifted to the view that he held for the rest of his life, namely that it was monetary policy that was the important thing to get right, and then fiscal policy could vary around that. So my point is that he was a smart theorist who could devise a hypothesis and theory to explain something, but not many economists go on, well, a lot of economists just stop there. They don't take the next step and really check the data. There's so many blackboard economists, I call it. So his early conventional view of monetary policy was theory-based, not empirically based. Now, the way he liked to present his view on fiscal policy, one that he presented, was always to say, basically, there's only three ways to finance an increase in government spending or an increase in the budget deficit. You can either tax, or borrow, or print. If you tax, that crowds out some private sector spending. If you borrow, that crowds out some private sector borrowing, and that will influence investment. If you print money, that changes the total volume of spending, the total nominal spending, including government spending, and that will change things. So the hypothesis from this is that fiscal policy cannot be either expansionary or contractionary without monetary policy acting in the same direction. So if you just have the fiscal expansion or fiscal contraction, but monetary policy is unchanged, is it going to work? Well, at the beginning of my paper, I had this quote, and you can find similar quotes from Friedman in a number of places. Here we go. One of the things I've tried to do over the years is to find cases where fiscal policy is going in one direction and monetary policy is going in the opposite. In every case, the actual course of events follows monetary policy. I have never found a case where fiscal policy dominated monetary policy. And I suggest to you, as a test, to find a counter-example. And again, people will not do the research, do the checking to find these cases. So, next slide please. The main part of my paper then is to present you with an idea to kind of encapsulate this notion of freedom. Here we've got a matrix with expansionary or contractionary fiscal policy on the left-hand side in the rows, and monetary policy in the columns, expansionary or contraction. And that gives us naturally four cases. So what Friedman says is, when you have the two policies, monetary and fiscal, working in the same direction, case A or case D, then you always get results. But of course you can't distinguish between them. Which one is really causing the problem? Which one is causing the change? From a scientific point of view anyway. However, the really interesting ones are the intermediate ones, where you have cases B and C, where you have policies working in the opposite directions. And in a few moments I have time to explore case B a bit more, because that describes in a way the situation in the United States today. That is to say, where we have Trump's fiscal expansion, the cut in taxes, the increase in defense expenditures, and yet the Fed is raising rates. So, if anything, the Fed is, well, you could say it's normalizing, it's not really tight, but in any case, that's exercising Wall Street and all the investment bank analysts, and certainly all the people on the FOMC, who are very nervous that this is going to lead to inflation. But the Friedman analysis will be, No, it's not. As long as monetary policy is on course, then it's not going to lead to inflation. So why is it that it doesn't? How can it be that a decrease in taxes, such as we've had from Trump, is not inflationary? Well, the answer is that the usual analysis of a tax decrease, a tax reduction, is only half the story. It's true that if taxes are reduced, then taxpayers have more to spend. So far as that goes, that does increase the pressure of demand. But we have to look at the other side of the government's account. If the government continues to spend what it otherwise would have spent, it now has to borrow more in order to finance it. If it raises, in the current case, is $200 billion more, $200 billion less in taxes, it needs to get financing from other sources of $200 billion more. If the increased funding or fundraising from other sources occurs because it borrows $200 billion more, then that means that those who would have loaned out that $200 billion to private sector borrowers, firms and households, now have $200 billion less to maintain consumption or lend to somebody else. Taxpayers have more. Potential private sector borrowers have less. So far as that goes, there's no net effect of a tax decrease on the funds available. They're just switched. So far as that goes, the effect of the tax decrease will be to raise interest rates, but it will not directly increase spending. It will mean that people who would otherwise have loaned the funds to the private sector will now be lending to the government. Private sector borrowers will simply be crowded out. So that's the analysis. And a lot of these tests you see in the econometric literature simply do not take account of the funding or the financing of the deficit. There's loads of examples of people testing how much an increase in the deficit increases nominal spending in the economy as a whole. But that is not a proper test, because it doesn't deal with the other side. So, the next slide, please. So the rest of my paper, the rest of my paper is on these concrete examples. Now, case B, I want to draw your attention to. This is what happened under Ronald Reagan. Reagan, as you remember, cut taxes, just like Trump. The budget deficit under Ronald Reagan, again, it was mainly expenditure on defense and tax cuts. The budget deficit went from 1% of GDP to 6% of GDP between 1981 and 1986. So a huge increase in the deficit. Did that lead to inflation? Not a bit of it. Why? Because 1981 to 86 was when Volcker was at the Fed and he was squeezing money. Monetary policy dominated over fiscal policy. There was absolutely no doubt about it. So you had a huge increase in the deficit. Inflation went from 15% down to 1%. Find me another example of that kind. I'd love it. So that's one case. Another case that's relevant to today is China's huge fiscal stimulus in 2008, 9, 10. I don't know how many of you have kind of looked at that, but China announced this huge fiscal stimulus at the end of, I think it was November of 2008, in the middle of the crisis. And China was widely given credit for sort of reviving the global economy, because the economy recovered very strongly, the stock market doubled, house prices went up steeply, the economy surged, commodity prices rose, and so on and so on. And then they had about 2 to 3 years of inflation at 6 or 7%. Fiscal stimulus worked, right? Wrong. Because at the same time, the money supply almost doubled. It went from an average of about 13 or 14% to nearly 30% for 2 years. There was a huge increase in monetary growth in China. So this is a case where you really can't tell the difference. But unless they'd had that monetary expansion, guess what would have happened? And if you think about it, all the other developed Western economies had that problem. That is, they had huge fiscal deficits, but no money growth. In most countries, money growth was very weak, and therefore the recovery was anemic. It took a long time to return to normal growth. And then I've got some other ones. Britain's 1931 budget and Britain's 1981 budget. I'll talk more about those in just a minute. Next slide, please. So then we've got some examples from the United States. I'm not going to go through this. Sorry. No, but there's the data on the Reagan tax cuts, excuse me. And the yes, sorry, and China's stimulus. Go to the next slide, please. This is the United States during the 1960s, and this comes directly from a lecture that I heard from Milton Friedman in Tokyo. It was the first time I met him back in 1969, and he walked the audience through the 1960s, explaining what monetary policy was doing, what fiscal policy was doing. And by extraordinary coincidence, there is one of each cases, A, B, C, and D, through the 60s. That's a brilliant illustration of the interaction. Next slide, please. Now, the UK. Anthony Barber's dash for growth is clearly top, case A. Alistair Darling in the Great Recession, as I've just implied, is case B. That is huge fiscal expansion, no monetary expansion. And then case C, we've got these famous and notorious budgets of 31 and 81. Case D in the UK, the only sort of good case that I can find is there may be others, Forrest later. What happened in the early 20s after, with the post-World War deflation, post-war deflation. Next slide, please. So, in detail, if you want it, it's in the papers. Here are the numbers. Now, it's really important to understand that when we're talking about monetary policy here, I'm using what Friedman used always. That is a broad definition of money. We're not talking about interest rates. In one or two cases, I wasn't able to get the numbers, and I used inflation, i.e. the net result. But generally, it's the quantity of money. Just to say this bluntly, monetary policy is not about interest rates, despite what you read from all the central banks, despite what you read from all the investment banks. Interest rates are the instrument for achieving, in Friedman's view, a rate of growth of the quantity of money. And it's that which influences spending, not the interest rate itself. Just very briefly on the famous and notorious 1981 budget. A number of you in the audience here were present at that. I was abroad, so it had less impact on me. But everybody knows that the budget balance, whether you take it as a PSBR number or whether you take a cyclically adjusted number, was narrowing sharply. So there was a fiscal squeeze, contraction in fiscal policy, and yet monetary policy was being eased. They did cut interest rates, and money growth was more than ample for the economy at the time. So I think that case fits into that. And somebody just mentioned, Anthony, your book, the joint book with Duncan, on contractionary fiscal expansions, right? Most of that debate focuses on fiscal only. And the papers of Alberto Alesina are all about whether cutting taxes is more efficient than increasing expenditure. Right? But it doesn't. That debate doesn't necessarily sort of clarify the difference between monetary and fiscal policy. And Friedman always said that for clear thinking on this, you've got to separate monetary and fiscal policy. And we in Britain had all this debate influenced in part by the IMF about the credit counterparts and DCE and full funding and all these things. But it's much clearer if you just separate the two. Okay, so next, please. I've got my sort of special topic is Japan, having lived there for 4 years and studied in the university there. And there are some wonderful cases from Japan which fit all these boxes. We don't have time to go into them now. Next slide, please. There's some detail on the first two, the Takahashi reflation in the 1930s. After Japan followed Britain off the gold standard, and then they had a massive expansion, which of course changed things dramatically for Japan. And then, like Britain, the deflation of the 1920s was a long and painful period because monetary policy contraction, even though they had consistent fiscal support for the government, for the economy. Next slide. And then finally, some other, next slide. These are post-war episodes. Tanaka's plan, Prime Minister Tanaka's plan to remodel the Japanese archipelago, and then the recent last decade or 2 decades. Basically, we've had fiscal deficit after fiscal deficit. The government monetary growth has remained anemic. It's remained at about 2% per annum. And the result is that Japan is continuously flirting with deflation. It simply hasn't revived the economy strongly. Next slide. So, what does the data show? I think I've shown you enough episodes to demonstrate that Friedman's hypothesis is broadly correct. And I would issue the same challenge to you. Can you find me a case where fiscal policy dominates monetary policy? Because I would love to find one. If it doesn't work, let's hear about it. So, basically the lesson is fiscal policy on its own is not effective in changing nominal GDP unless it is supported by monetary policy acting in the same direction. That's cases A and D in my matrix. Significantly, wherever fiscal policy was in one direction, but monetary policy was in the opposite direction, interesting cases that Friedman talked about, cases B and C, it was always monetary policy that dominated. Next slide. So, let me close then with this. Monetary policy, in the Friedman view, determines nominal GDP, or total spending. Now, of course, there are all the problems with the lags and the definitions. But it's been my experience that if you don't, it's better not to rely on official definitions. It's better to get the consolidated banking data and study it yourself, figure out what is money, what is not money, and then do the numbers yourself. If you do that, I think you'll find that relationship is pretty stable. And that depends on the relative or functional stability of velocity. And fiscal policy only determines, in that sense, the division of spending between private and public sector, between consumption and investment. So it's going to be misguided for any country, any policymakers, to use fiscal policy to boost nominal GDP or total spending, while monetary policy, i.e. broad money growth, remains unchanged. Or if broad money growth is moving in the opposite direction. So I think Friedman makes a sound case for fiscal austerity, even in recession, provided that it is accompanied by monetary expansion. I want to close on this point. If you read the analyses of central banks, the Fed minutes, the ECB, the Bank of England's inflation report, all the reams of stuff from investment banks, what you would think, as I said earlier, that monetary policy is all about interest rates. But Milton Friedman taught us that monetary policy is not about interest rates. See, the problem with interest rates is this. If you have an expansionary monetary policy, the first thing that happens is that interest rates decline. But then the economy picks up, demand for credit rises, inflation rises, and then interest rates rise. So the downward slope of the liquidity preference function It's simply unreliable. It is not a monotonic relationship between the interest rate and the quantity of money. And that basically undermines a huge slew of all these econometric models. I think the ECB and the Bank of Japan, in their pursuit of ever lower rates and negative rates, have made exactly that mistake by pushing rates down and down and down, because their models said eventually something will happen to spending. But they failed to expand the quantity of money. So, interest rates have been the chosen instrument of central bankers for achieving a particular rate of money growth, or for achieving some kind of nebulous set of policy targets. But as I say, in blunt terms, interest rates are not monetary policy. Monetary policy is about the growth of broad money. And broad money, or monetary policy in Friedman's sense, is what matters in nominal income growth, not fiscal policy. Thank you very much.